Welcome back to our channel, where we bring you the most important news about the U.S. economy, Wall Street, and global markets every day. Remember to subscribe to our channel and click the bell so that you won't miss any of our videos. Today we're going to discuss a truly incredible story about one of the largest retailers in the United States. If you've ever been to a shopping mall or used their online platform, chances are you've heard of Target, a household name known for its wide selection of goods and affordability. However, recently Target's shares have been in free fall, plummeting over 20%. But what's behind this collapse and how does it affect us? What should you do if you're already invested in Target shares? And should you be concerned about the future of this iconic retailer? Or is this a buying opportunity? Stick around until the end because we'll reveal it all. But first, let's start with a quick recap of what's been happening to Target lately. As one of the biggest bricks-and-mortar retailers in America, Target offers a diverse range of products from home appliances to groceries and clothing for all ages. The company has traditionally focused on providing high-quality goods at competitive prices. In addition to its physical stores, Target also has a thriving e-commerce platform, which has seen exponential growth in recent years due to the pandemic. Despite being a market leader in the retail industry, Target's performance hasn't been exceptional recently. On March 1st, Target released its fourth-quarter earnings report revealing some disappointing figures. While revenue increased by 4.3% compared to the same period last year, net income plunged by 94%, dropping from $978 million to just $46 million. This significant decline in profitability caught investors off guard, leading to a sharp drop in Target's stock price. To better understand why Target's profits collapsed, let's dive into some key factors. In recent years, Target has faced increasing pressure to raise wages for its employees in order to attract and retain talent. In an increasingly competitive job market, higher wages can help Target stand out as an employer of choice. Additionally, paying employees fairly can lead to increased morale and productivity, which can positively impact the company's bottom line. However, rising wages can also put pressure on profit margins, especially if they increase faster than revenue. This may be one of the reasons why Target's profits have been squeezed in recent quarters. Another potential reason for Target's declining profits is rising transportation costs. In the retail industry, transportation is a major expense, as retailers need to transport goods from manufacturers to their distribution centers and stores. In recent years, transportation costs have been increasing due to various factors such as higher fuel prices and a shortage of truck drivers. These rising costs can eat into profit margins and make it challenging for retailers like Target to maintain profitability. It's not just rising wages and transportation costs that are affecting Target's bottom line. Suppliers also play a crucial role in the profitability of retailers. When suppliers raise their prices, retailers like Target must either accept lower profit margins or pass on the higher costs to consumers, which can impact sales volume. In today's economy, many suppliers are dealing with their own set of challenges, such as rising input costs and supply chain disruptions, which can lead them to increase their prices. This can put pressure on Target's profit margins and make it difficult for the company to maintain profitability. While these three factors may seem relatively insignificant on their own, when combined, they can have a major impact on a company's overall profitability. Moreover, there are other challenges that Target faces, such as low demand for some key categories, such as electronics and clothing, as well as fierce competition from big-box retailers like Walmart and online giants like Amazon. In fact, the retail sector is one of the most competitive industries in the world, and Target faces constant pressure to keep its prices low and its product selection competitive. Furthermore, changing consumer behavior driven by factors such as the rise of e-commerce and a preference for experiences over material goods can also impact Target's sales and profitability. In a recent earnings call, Target CEO Brian Cornell acknowledged these challenges, stating that the company was facing a unique set of obstacles during the holiday season that negatively impacted sales in some categories. He also mentioned that the company was taking steps to address these issues, such as reducing costs and improving the customer experience. Now let's see how this affects the stock market. After releasing these numbers, Target's stock began a rapid descent, plunging by more than 20% in a single day. To better understand this decline, let's take a closer look at the technical aspects of the stock movement. As we mentioned earlier, on March 1st, Target released its Q4 earnings report. However, the company also provided guidance for the next quarter, which may have contributed to the sell-off. Typically, investors use forward guidance as a way to anticipate a company's future performance. However, if the guidance is below expectations, it can cause the stock price to fall as investors adjust their portfolios accordingly. In the case of Target, the stock price dropped significantly after the announcement of both quarterly results and guidance, suggesting that the market was expecting higher earnings and revenue from the company. To further understand the situation, it's helpful to compare Target's performance with other retail companies. If Target's results were worse than those of its competitors, investors may have reacted negatively and sold their shares, leading to the stock price decline. For example, if Walmart, another major retailer, reported strong earnings and revenue growth while Target reported a decline, investors may have rushed to sell Target shares and buy Walmart shares, driving Target's stock price down. But that's not all. Many large investors and mutual funds hold Target shares in their portfolios, and their reactions to the earnings report could have also influenced the stock price. If major investors such as hedge funds or index funds decided to sell their Target shares, it could have triggered a further decline as more shares became available on the market. Hedge funds often buy and sell stocks based on their short-term performance and financial outlook, meaning they may have sold Target shares if they believed the company's future prospects were dim. So how much are financial analysts and experts talking about this event? Let's find out. It turns out that many financial analysts and experts have commented on the recent decline in Target's stock price. Most agree that the disappointing earnings report and weak guidance contributed to the sell-off. Some analysts have downgraded their rating on Target shares and lowered their price targets, citing concerns about the company's future performance. For example, Morgan Stanley analysts said that Target's results were weaker than expected and that the company faces challenges such as increased competition and changing consumer behavior. They downgraded their rating on the stock to equal weight and lowered their price target to $160 per share. Other analysts, however, have maintained a more optimistic outlook on Target. For example, Telsey Advisory Group analysts believe that the company's fundamentals remain strong and that the stock price decline presents a buying opportunity. They noted that Target's digital business is growing rapidly and that the company is taking steps to address its challenges, such as reducing costs and improving the customer experience. Overall, the general consensus among experts seems to be that Target's short-term performance may be lackluster, but that the company has the potential to rebound in the long term. Now let's move on to the most important question. What should you do if you already own Target shares? Well, if you're a long-term investor with a horizon of more than 5 years, this decline may present a buying opportunity. That's because when the stock price falls, it allows you to buy more shares with the same amount of money. However, it's essential to monitor the company's future performance closely to ensure that it's taking the necessary steps to improve its profitability and compete effectively in the retail market. On the other hand, if you're a short-term investor with a time horizon of less than 5 years, you may want to consider selling your shares and investing in a more stable company. Before making any decisions, it's important to conduct thorough research, read the company's latest financial reports, and consult with a financial advisor to determine the best course of action for your individual circumstances. For new investors who don't yet own Target shares, now might be a good time to buy. That's because when a stock price drops, it becomes more affordable, allowing you to purchase more shares with the same amount of money. Additionally, if you believe in the company's long-term growth potential, this decline may present a valuable opportunity to invest in a high-quality company at a lower price. However, it's essential to stay informed about the company's financial health and future prospects before making any investment decisions. Now let's talk about what the future holds for Target. The company is currently working on several initiatives aimed at regaining investor confidence and improving its financial performance. One of the key focus areas for Target is reducing costs. The company has been exploring ways to optimize its supply chain, negotiate better deals with suppliers, and reduce waste. By lowering costs, Target can improve its profit margins and increase profitability. Another important initiative for Target is improving the customer experience. The company has been investing in its stores, enhancing its website and mobile app, and expanding its omnichannel capabilities. By providing a better customer experience, Target aims to drive more sales and build customer loyalty. In addition to these efforts, Target is also focusing on expanding its digital business. The company has been investing in its e-commerce platform, developing a strong social media presence, and expanding its omni-channel capabilities. By growing its digital business, Target aims to reach more customers and drive sales. Looking ahead to earnings, analysts are forecasting that Target will post a 36% decline in earnings this quarter, with estimates ranging from a loss of $126 to $114 billion. The consensus estimate for revenue is $29.76 billion, with an average estimate of $29.74 billion. Compared to the same period last year, revenue is expected to decline by 4.53%. Despite these challenges, some analysts are optimistic about Target's future prospects and believe that the current decline in stock price presents a buying opportunity. Only time will tell whether these analysts' predictions are accurate and Target is able to turn its performance around. However, it's important to remember that past performance is not indicative of future results and that investing in the stock market always carries some level of risk. And that's all for today. We hope you enjoyed this video and learned something new. Please remember to leave your thoughts and opinions in the comments section. And if you haven't already, hit the like button and subscribe to our channel to get notified of our latest videos. Stay tuned for more updates. Thank you for watching, and we'll see you in the next video.